Hello everyone and welcome to the class of Financial Institutions and Markets Econ 242. My name is Yasser Saeed. This is lecture number 13 on the stock markets. I'm going to study the remaining part of our lecture. We covered earlier about the stock market definition, and then afterwards we discussed that there are two types of instruments or stocks that are traded in the stock market. One we call the common stock, and the other one we call the preferred stock. So we had a detailed discussion on the nature of the common stock, the characteristics that were related to the common stock. Today in this lecture we are going to study the preferred stocks and how they are different from the common stocks, and afterwards we are going to study the two types of markets that exist in the stock market. One is the primary market, where shares are issued for the first time, and then we have the secondary market where the already issued shares are traded time and again. So this is our course outline for today's lecture. Preferred stock. A preferred stock is a hybrid security that has characteristics of a bond and a common stock. Preferred stock is similar to common stock in that it represents ownership interest in the issuing firm, but like a bond, it pays a fixed periodic dividend payment. Preferred stock is senior to common stock but junior to bonds. Therefore, preferred stockholders are paid only when profits have been generated and all the debt holders have been paid. But this happens before the common stockholders are paid. Like a common stock, if the issuing firm does not have sufficient profits to pay the preferred stock dividends, the preferred stockholders cannot force the firm into bankruptcy. Further, if the issuing firm goes bankrupt, preferred stockholders are paid their claim only after all creditors have been paid, but before the common stockholders are paid. So they have a degree higher than the common stockholder, but still they are paid the end of the at the end of the chain. They come up at the second last position. Corporations find preferred stock beneficial as a source of fund because, unlike coupon interest on a bond issue, dividends on preferred stock can be missed without fear of bankruptcy proceedings. Additionally, these preferred stock it is beneficial to an issuing firm debt holders. Fund raised through a preferred stock issue can be used by the firm to fund the purchase of assets that will produce income needed to pay to the debt holders before preferred stockholders can be paid. Preferred stockholders also have its drawback for the corporation. The first drawback is that if a preferred dividend payment is missed, new investors may be reluctant to make investment in the firm. Therefore, the firms are generally unable to raise a new capital until all the missed dividend payments are paid on preferred stock. In addition, these types of stockholders must be paid a rate of return consistent with the risk associated with such stocks. And that is, the dividend payment may be delayed, so it has the association of that type of risk. Therefore, preferred stock may be costlier source of funding for the issuing firms as we compare it with the bonds. Then there is a second drawback of the preferred stock from the issuing firm's viewpoint, and that is that unlike the coupon interest paid on the corporate bonds, the dividends paid on preferred stock are not tax deductible expense. Preferred dividends are paid out after the tax earnings. This raises the cost of preferred stock relative to the bonds for a firm's shareholder, and specifically this difference in the tax treatment between coupon interest and the debt and preferred stock dividends affect the net profit available to common stockholder of the firm. Dividends on the preferred stock are generally fixed and paid quarterly and are expressed either in dollar amount or percentage of the face value, just like happens in bonds. Uh, Preferred stockholders generally do not have the voting rights as the common stockholders have. An exception to this rule may exist if issuing firm has missed a promised dividend payment. For example, preferred stocks in a certain corporation that was known as Pitney Bowes Incorporation has no voting rights except when dividends are in arrears of six quarterly payments. In this case, the preferred stockholders can elect one-third of the board of directors, so they can get the ownership. If a certain situation occur, they are unable to get their dividend payments on time. So these type of situations can occur. Then the preferred stocks have two types of characteristics. One we call the non-participating preferred stock, and the other is the cumulative preferred stock. So these two characteristics can exist at the same time in a preferred stock. The non-participating preferred stock means that the preferred stock dividend is fixed regarding of any increase or decrease in the issuing firm's profit. So they do not have any share in the extra profit earned by the firm. Again, if the firm is continuously facing losses, then in that case, still the non-participating preferred stockholders still get their dividend, but that does not change with the level of profit. When the profit changes, nothing happens to the overall profitability of these non-participating preferred stockholders. There is a second property relating to it, that is the cumulative preferred stock. What does this mean? It means that any missed dividend payment go into arrears and must be made up before any common stock dividends can be paid. For example, during the peak of the financial crisis in the 2008, the federal government instituted a program, and that program was called Capital Purchase Program. And a component of the Troubled Asset Relief Program, which was called TARP in short, the CPP involved the US Treasury investments in hundreds of financial institutions. In return, the US Treasury received shares of the preferred stock. So the government had the shares of the preferred stock, and these preferred stocks carried a 5% cumulative dividend rate for the first 5 years and then reset to a 9% dividend. So even in certain cases when the firm uh, failed due to any further crisis or the firm was unable to pay the dividend, it got accumulated and the firm had to pay it at certain level. Then the 9% was in the remaining period. So again, that was also cumulative. So cumulative preferred stock basically mean the dividend cannot be missed, and if it is missed, it must be paid before any return is given to the common stockholders. As we discussed the two types of the preferred stock, the non-cumulative preferred stock, sorry, the cumulative preferred stock and non-participating preferred stock. We have the presence of the opposite to that as well. That is the participating preferred stock and the non-cumulative preferred stock. So in participating preferred stock, it means that the actual dividends paid in any year may be greater than the promised dividends. And this happens in some cases. If the issuing firm has an exceptionally profitable year, the preferred stockholders may receive some of the high profits in the form of an extra dividend payment. In other, the participants preferred stocks pays and changes the dividends along the same line as the common stock dividends. For example, we have a corporation that is called the Swanking Corporation, and it has a preferred stock outstanding that pays up to 100 times the amount paid on the common stock. So that is a very unique and very high type of dividend payment that has been observed. Then we can have preferred stock that is non-cumulative, and non-cumulative preferred stock means that the missed dividend payments do not go into arrears and they are never paid. And again, we have an example of Doral Financial Corporation that is a non-cumulative preferred stock, and that corporation entitles the stockholders to monthly dividends based on an annual rate of $0.15 per share. But what happened is that in March 2009, the Doral Corporation suspended the non-cumulative. They suspended the dividend payments on their preferred stock, and the dividend payment did not go into arrears. So the non-cumulative preferred stock is generally unattractive to the prospective preferred stockholders. Thus, non-cumulative preferred stock generally has some other special features, and that is that these shareholders might be given voting rights. So, in order to what we can say is to make up for the drawback of this type of preferred stock, what the corporation do is give the investors some of the voting rights, and they can choose their board of directors. So they somehow act like the common stockholder in such cases. So next we come up to the two types of markets, that is the primary stock market and secondary stock market. We start with the primary stock market. These markets in which the corporation raise funds through new issue of stocks. The new stock securities are sold to the initial investors that we call the supplier of the funds in the exchange for funds money that the issuer uses, that the issuer needs actually. And this is illustrated in the graph. As you can see that the most of the primary market transactions go through the investment bank, and these investment banks can be, these are not the typical commercial banks, but nowadays the commercial banks do perform the function of investment banking as well. So they may have investment banking branches as well, and which serve the intermediary between the issuing corporation and the ultimate investors in the securities or the shares. Likely, like the primary sale of bonds, as we have discussed in the earlier chapters, the investment bank can conduct a primary market sale of stocks using a firm commitment underwriting, where the investment bank guarantees the corporation a price of newly issued securities by buying the whole issue at a fixed price from the corporate issue. Or there can be another type of underwriting that we call the best efforts underwriting, where the underwriter does not guarantee the price of the price to the issuer, but acts more as a placing or distributing agent for a certain amount of fee. In a firm commitment underwriting, the investment bank purchases the stock from the issuer for a guaranteed price called the net proceeds. The net proceeds are basically the price at which one investment bank purchases the stock from the issuer. Now, then what happens next is the firm sells it to the basic investors, and when they sell it to the investors, that is called the gross proceed. The gross proceed means the price at which the investment bank resells the stock to the original investors. So this selling, when the investment bank purchases from the the original firm, that is called the net proceeds, and when it sells to the actual investor, that is called the gross proceed. The difference between these two is called the underwriter spread. So this spread is actually the income for the investment banks. The investment banks earn from the difference from which they have purchased from the original firm, and then the difference from that price to with the price on which they have sold to the original investors. Then often these investment bank will bring in a number of other investment banks to sell and distribute the new issue. So this group is called a syndicate. For example, the stock issue announcement of 33 million shares of common stock in the Macri company had that company had 10 investment banks involved in the initial issue, but the main issuer that was only one. And what we call that issuer who issues the that leads the syndicate, that is called the lead bank in the syndicate, that is called the originating house, which negotiate with the issuing company on behalf of the syndicate. So syndicate is basically a group of investment banks led by a single bank which deals on their behalf with the corporation, and again on their behalf with the individuals. So what happens once an issue is arranged and in terms set, each member of the syndicate is assigned a given number of shares to issue for which it is responsible for selling. Then shares of stock issued through a syndicate of investment banks spread the risk associated with the sale of stock among several investment banks. A syndicate also results in larger pool for potential outside investors, increasing the probability of a successful sale, and it also widens the scope of the investor base. So a primary market sale may be the first time issue of a private firm going public, allowing its equity, some of which held privately by managers and venture capital investors, to be publicly traded in the stock markets for the first time. So when these shares are issued for the first time, that is referred to as the initial public offering. And an example of this could be in 2010, Smart Technology was firm that raised 660 million in initial public offering, and that is considered to be the biggest initial public offering of the common stocks in the United States. Then the financial crisis of 2008 and 2009 resulted in a large decline in the initial public offering activity. Indeed, the US initial public offering market which virtually seized up with a record-setting stretch of inactivity that began in August 2008 and ended in November 2008, and only 20 initial public offering happened during that specific time period, that of 2008. Then alternatively, the primary market sale may be seasoned offering, in which the firm has already issued some of its shares, but then again it offers further more shares. In both cases, the issuer receive the proceeds of the sale, and the primary market investor receive the securities like a primary sales of corporate bond issuer. The corporate stocks may initially be issued through either public sale, where the stock issue is offered to the general investing public, or it may happen through a private placement, where stock is sold privately to a limited number of large investors. A very interesting concept that is related to the stock market is that of preemptive rights. Corporate law in some countries and in some states have a certain charter that gives the shareholders a preemptive right to the new shares when they are issued. So this must first be offered to the existing shareholders in such a way that they can maintain their proportional ownership in that corporation. A right offering generally allows existing shareholders to purchase shares at the price slightly below the market price, and these stockholders can then exercise their rights buying the allotted shares in the new stocks or sell them. The result can be a low-cost distribution of new shares for the firm, but the issuing firm avoids the expense of the underwriting offering. Suppose you suppose for example that there was in 2010 a Clearwell Corporation that announced a right offering to its common stockholders, and they intended to raise 291 million in new stocks at subscription price of their price was set to 7.3 or something dollars per share. um, Now, what happened was that they issued 39.6 million new shares of the common stock. Each subscription right allowed shareholders to purchase somewhat zero point 0.5 of a share of that corporation of Class A stocks. Then the offering purchase of new shares in the Clearware at a discount as much as 0.96 or equal to $1 per share from the market price of the stock. So these rights could be sold by the corporation to stockholders or to any other investors. Rights are similar to the options in that they give the holders the option but not the obligation. They're not obligated to buy, but they are given the option to purchase it, and again at a lower price, and to buy back the stock at a fixed price. Sometimes this happens that the corporation issued the stocks and again they buy back after a certain period of time at a certain higher price. The right holder has the option of buying these new shares at stated price, selling the rights to other investors, or letting the rights expire at the end of the offering time period. About the primary stock market. Hope to see you in the next lecture, and we will discuss about the secondary stock market and how shares are traded over there. Thank you very much.